Good afternoon, everybody. I hope everyone is doing okay during the circuit breaker period, or affectionately known as the CB period in Singapore. Yes. Do you know that banks are ripping you off all this while? Would you like to know how you can get even with them? Hi everyone, this is Alec and I'm a property consultant with PropNext, and today I'm going to show you how you can turn the tides on the banks, right? So if you have seen my previous video on equity term loan, you would have known that you are able to cash out or via refinancing your substantially paid up or fully paid up property to get capital out from your property for your own usage. Like for example, if you are in a business, you can use it to supplement your cash flow, or if you're an employee or currently that you're unemployed, you can use that to supplement your day-to-day expenses. But do you know you can also use whatever capital that you have released from your property to reduce whatever loan, high interest loan specifically, that you are currently paying. Let me give you an example. If you have a credit card loan with a bank, chances are the interest they are charging you is 20% or more. If you have a personal loan, it is going to be quite high up there, maybe to the tune of 7-8%. If you have a car loan, I haven't checked the car loan for quite some time, but based on my own experience, when I bought my car 2.5 years back, I was paying 2.9% for my car loan. Okay, so if you have a car loan, likely you are paying around that as well. Do you know you can now reduce the interest that you are paying on all these loans that I just mentioned earlier, and at the same time stretching the tenure beyond the 5 or 7 years that is legally allowed to you? Okay, this is where equity term loan can help you. Aside from helping you with the business cash flow for your day-to-day sustenance, you can use the cash that you get from your equity term loan to first pay up your car loan. So effectively, you are switching from a high interest, short repayment loan term to a longer period but lower interest term. Do you see what I'm getting at? So let me just give you a very rough example. If you're getting a car loan, 100,000 car, you can take a 70% loan at 3% interest, right? You'll be ending up paying around $1,000 a month every month for your car installment. Now picture this. If you get the same 70,000 from your equity term loan based on today's interest at roughly 1.6%, at the same 7-year tenure, you are paying $800+. So that is close to a 20% savings. And what more, with an equity term loan, you can actually pay over a longer duration, right? Like say, for example, a 15-year loan, right? 15-year loan at 1.6%, you are paying at a monthly rate at about $400+. That is a 50 over to 60% savings in your monthly installment. Now think of what that can do for you in terms of your cash flow. You are, let's say, committing to a couple of $1,000 in, let's say $5,000 in your total loan repayment, car loan, personal credit, whatever loan, right? So if you take this equity term loan that you take out, you fully paid out your credit card loan, your car loan, your personal loan, and effectively you are reducing the amount that you are paying, because now all these loans is effectively transferred to the equity term loan that you're paying. So you are reducing maybe from a $5,000 loan repayment every month to maybe a $2,500 to $3,000 repayment. That is a good $2,000 you save every month in terms of your loan repayment. So this is how you get even with the banks, with the low interest environment currently. And of course, with the equity term loan, you can effectively stretch to a longer tenure depending on your age, right? And that would effectively reduce the amount that you pay further, right? Aside from only the savings on the interest. So give this a really, really good thought. right? This is the best chance for you to take advantage of all this situation where you can get cash out from your property to effectively pay off what I call your bad loans. The high interest loans is what I call the bad loans, and use this good loan which is the effectively a mortgage loan to pay off all these liabilities that you have. So I hope this tip has been helpful to you. So see you in the next video. Thank you very much.